For you, what were the highlights of 2013?
Well, 2013 has been a very encouraging year for us, really on three counts. Firstly, we're delighted with the progress we've made with our strategic repositioning of the portfolio. We've sold almost £600 million worth of assets, and we've reinvested £250 million of those proceeds into new acquisitions and very profitable developments. The second big highlight will be the creation of our European logistics joint venture, SELP, as we call it, which is a really important step forward for us in terms of building our presence in a market that we think is very attractive going forwards. And then the third point is operationally we've seen some encouraging performance. There's been an improvement in occupier demand, but also the improving market conditions have been reflected in our portfolio valuations, which in the UK have risen sharply, enabling us to report a 6% increase in net asset values over the year.
Now, as you've mentioned, you've completed your logistics joint venture in Europe. Why is that important?
Well, we think there's a very big opportunity in this vast European logistics market. And in order to be a serious player and to have benefits of scale, cost efficiency and deep customer relationships with the key players there, you need to have scale. And in order to have scale, you need to have access to a lot of capital. So it's a really important step in enabling us to have access to the money we need to be able to invest and compete in this very exciting sector.
Let's look in more detail at operational performance. What have been the key factors there?
Well, in most of the markets we're operating in, the demand situation has been gradually improving during 2013. At the same time, supply has remained very tight. So we've been able to take advantage of that situation and report a significant increase in the amount of new rent commitments during the year, which are up 17% compared to 2012's level. We've particularly seen a pickup in demand for new space, and that's fed into a large number of pre-let developments signed for future delivery, but also seen some quite good demand for existing space in a number of our markets, particularly in Slough, in and around Heathrow, Park Royal and in Germany. Meanwhile, we've maintained a very strong customer focus. We've improved our customer satisfaction levels, and that's enabled us to hang on to a lot of our customers when they come to a lease expiry or a break option. Our retention rate for the year was up to 69% from 64% last year. So overall, we're pretty encouraged by the operational performance for the year.
So how are you differentiating yourself from competitors, and what's been the impact on performance?
Where we particularly distinguish ourselves against the competition would be in our ability to provide edge-of-town distribution space. That's where a lot of the demand for so-called last-mile delivery is playing into our hands, because not many companies have that type of space or the land available to build the type of warehouses that the retailers and the parcel delivery companies need, all of whom are seeing a huge growth in this type of business on the back of internet retailing becoming a much bigger part of the whole retailing world.
There seems to have been a tick-up in development activity. What's been the picture there?
Yes, we've had a very busy year of development. We've completed 15 schemes during the year, generating 144,000 square metres of new space, and that will contribute almost £7 million of new income when it's all fully leased up. And in fact, 85% of those schemes are all now leased up through pre-commitments. And then we've been adding to the pipeline with new pre-lets and indeed some new speculative schemes during 2013. So we ended the year with 18 projects under development, equivalent to about 250,000 square metres of new space. And the rental income attached to those will be about £17 million, of which 60% has already been pre-leased.
So finally, what do you see for 2014 and beyond?
Well, in many respects, more of the same. We've been on a journey over the last 2 years, which has been around repositioning the portfolio, strengthening the balance sheet and building a platform to enable us to grow going forwards and to deliver much better shareholder returns. But the work's not finished, so we still have some more repositioning work to do. But generally as a business, I feel we're much better positioned now to take advantage of the recovering economic environment and particularly the structural drivers of demand that I think will benefit our portfolio.